If there is one thing I wish more people understood about compounding, it is that the beginning feels insulting. That is the right word. Insulting, you save, you invest, you stay out of trouble. You do what every sensible person tells you to do. Then you open the account after months of restraint, months of saying no, months of working and waiting, and what you see does not look like freedom. It looks like a small pile of effort. That is the part people are usually too embarrassed to admit. They think disciplined people are supposed to feel inspired by the early stage. Most do not. Most feel underwhelmed. And if they are being honest, a little cheated. They think, I have been doing the right thing for years. Why does this still feel so small? That question has destroyed more financial futures than most market crashes. Not because the question is foolish, because the person asks it at exactly the wrong moment. He asks it while the machine is still building pressure. He asks it while the numbers are still in the stage where his contribution matters much more than the growth. He asks it before the curve has had enough time to become emotionally believable. Then he does something expensive. He quits, or he changes the plan, or he chases something louder, or he decides the whole idea was designed for someone richer than him. That is tragic, because the beginning of compounding is supposed to feel slow. It is not broken, it is young. That difference matters more than people realize. I have spent most of my life around money, businesses, and long cycles. One of the great advantages of age is that you begin to see how little of life is driven by excitement, and how much of it is driven by structure maintained for longer than the crowd can tolerate. Compounding is a perfect example. The crowd loves results. Compounding loves time. The crowd loves proof. Compounding asks for faith first and proof later. The crowd wants visible movement. Compounding does its most important work before it becomes dramatic enough to satisfy the eye. That is why so many people fail at it. Not because they are stupid, because they keep judging an early stage machine by late stage expectations. I once knew a young woman who reminds me of thousands of others in the same position. Call her Andrea. She was 28, steady, intelligent, employed, not extravagant, not reckless, and by all appearances exactly the sort of person who should have been rewarded for doing the right thing. For several years, she had been putting money into the market every month. Not a fortune, just a few $100s with consistency. No fancy moves, no dramatic bets, no non-stop trading. She was doing exactly what all the respectable advice columns tell young people to do. And one evening she looked at the account and felt almost offended by the result. The number was not nothing, but it was not life-changing. It did not look like escape. It did not look like the emotional payoff that years of self-restraint had been silently promising her. She had done the work. The account, in her eyes, had not done enough back. That is the dangerous moment, not when the market crashes earlier. When discipline has lasted long enough to feel sacrificial, but not long enough to feel magical. That is the valley where most people lose the plot. They think they are failing when they are actually approaching the point where the machine stops needing to be pushed quite so hard by hand. I think about compounding the way I think about pushing a heavy object at the beginning. The first effort is always the ugliest. A stationary object resists motion. The early years of investing do the same thing. You put in money, the money does not yet have enough history or scale to produce emotionally satisfying movement, so the whole experience feels like labor. You are the engine, your paycheck is, your discipline is the engine, your restraint is the engine. The portfolio is not yet behaving like an independent force. It is behaving like a container into which you keep dropping sacrifice. That is a lonely stage if no one has explained it properly. And most people do not explain it properly. They tell you to be patient. That is true, but incomplete. They tell you that time in the market matters. Also true. But they rarely tell you what the beginning is actually supposed to feel like. They rarely tell you that there is a stage where almost everyone feels disappointed. They rarely tell you that the line between the people who eventually experience the beauty of compounding and the people who never do is often nothing more glamorous than this. One group stays through the disappointing years. The other group interprets disappointment as evidence that the process is flawed. I prefer a clearer framework. If you're going to trust a long process, you need shape, not slogans. And for my own thinking, I like a structure that is simple enough to remember and strong enough to matter. 753. 1. Those numbers are not magic. They are a way of anchoring the right expectations so that emotion does not destroy arithmetic. Let me begin with the first number, 7. A great many people treat a year or two of investing as though that should be enough time to judge whether the process works. That is like planting a tree and becoming furious because it has not created shade by the second summer. It is also evidence that the time frame was wrong. The market is not a machine for rewarding people on your preferred emotional schedule. It is a machine for rewarding patience, if patience survives the period where patience feels unrewarded. 7 years matters because it begins to cross out a great deal of short-term nonsense. A bad year can happen. A crash can happen. A period of stagnation can happen. A euphoric rally can happen and disappear. But as you lengthen the horizon, you start giving underlying productivity and reinvested earnings enough room to matter more than headlines. That is the whole point. The person investing for 12 months is still negotiating with randomness. The person investing for 7 years begins to move out of the casino part of the building and into the ownership part of the building. That does not mean 7 years is a guarantee of emotional comfort. It is a guarantee of a better relationship with odds. That is a big distinction. I have seen people think in 1-year frames and then act surprised that they feel anxious every month. Of course they feel anxious. Their entire mental structure is too short. They are trying to extract reassurance from a process built to work over something much longer. It is like checking the oven every 2 minutes and concluding the meal is defective because dinner is not ready yet. The repeated checking changes the emotional experience far more than it changes the outcome. This is one reason I tell people that long-term investing is partly a time discipline and partly an identity discipline. You must decide what kind of owner you are going to be. Are you an owner who expects visible reward on a short cycle, or are you an owner who understands that there is a long, invisible phase where the foundations are being built? The second type becomes wealthy more often, not because he is more brilliant, because he is playing a game more aligned with reality. When a person truly commits to a 7-year frame, something important happens in his head. He stops treating the account like a weekly scorecard and starts treating it more like a field under cultivation. This does not mean he becomes careless. It means he becomes less emotionally jerky. A down month matters less. A bad quarter matters less. He stops interpreting temporary ugliness as a referendum on his intelligence. That is a huge win. A calmer owner usually makes better decisions. A frantic owner usually creates his own wounds. Now, a 7-year commitment does not help much if the money itself is arranged foolishly. That brings me to the second number, 5. People like to say they are diversified when they are merely scattered. Those are not the same thing. Owning 5 funds that all depend on the same economic kindness is not true diversification. Owning 10 fashionable names in the same corner of the market is not diversification either. That is a cluster of hopes. Real diversification means the portfolio contains different engines, different behaviors, different temperaments, different responses to conditions. You want productive assets? Yes, but you do not want every part of your financial life rising and falling for the same reason. That is fragility dressed up as variety. If I were building a sensible long-term structure for an ordinary investor, I would want 5 broad categories that each perform a different job. First, broad market ownership. Second, dependable dividend payers. Third, smaller growth businesses with more room to run. Fourth, international exposure. Fifth, defensive ballast. Let me take those one at a time because the role matters more than the label. The first category is broad market ownership. This is the great engine for most people. It is not flashy. It is not dinner party material. It is simply a way of owning a large piece of productive enterprise without pretending you know which single company will rule the future. The beauty here is not elegance. It is humility. A broad market fund admits something that too many egos resist. You do not need to be a prophet to participate in progress. You only need to own enough of it, cheaply enough, and hold it long enough. This category gives you the foundation. If businesses broadly do better over time, you do better. If productivity grows, you grow. If innovation increases earnings, you share in that. It is not a perfect instrument, but it is a very good one. And because it is broad, it reduces the risk that one individual mistake becomes a life-altering event. The second category is dividend payers. Now, I have always admired businesses that do not merely promise future greatness, but already generate enough cash to send a portion of it back to the owner. That tells you something important. It tells you the enterprise is not only alive in theory, it is producing surplus, a steady dividend. Paying business often behaves differently from a pure growth story. It may be slower, it may be less exciting. Fine. Excitement is an overrated financial trait. What matters is that dividends create a second form of progress. Even when prices drift, cash still arrives. Reinvested properly, those distributions become additional ownership, and later in life, they can become a stream of income. There is a psychological advantage here too. A person receiving dividends begins to understand ownership more concretely. The market is no longer just a scoreboard. It is a source of economic participation that matters. The third category is smaller growth businesses. This is where a little more volatility can be justified because the runway is longer. Smaller enterprises can grow faster than giant established. Giant simply because the base they are growing from is smaller. That creates opportunity. It also creates more risk. That is why this category should not dominate the whole structure. Used properly, it adds energy. Used badly, it becomes a place where greed convinces a person to turn a portfolio into a casino. I have nothing against owning younger or smaller companies when the price is sensible and the role inside the portfolio is understood. What I dislike is when people confuse concentrated hope with intelligent risk. That is the difference. The fourth category is international exposure. Many people still behave as if the United States is the whole investable universe. I understand the emotional habit. America has produced extraordinary businesses and extraordinary wealth. I have built my life in that world and admire it deeply. But admiration is not a reason to ignore the rest of the planet. Opportunities, industries, demographics, and economic cycles do not all exist inside one national border. Owning a piece of the world beyond your home country introduces a different source of return and a different kind of protection. Different regions lead at different times. Different currencies matter at different times. Different valuations matter at different times. A portfolio that owns only what feels familiar is often more emotionally comfortable and economically narrower than it should be. The fifth category is defensive ballast. This is the part the young often mock and the old often appreciate: cash reserves, short-term fixed income, defensive positions that will not deliver thrilling long, run returns but can steady the mind and the structure, when the equity side becomes ugly. This category has one essential job. It keeps pain from becoming panic. That matters far more than most people admit. A fully aggressive portfolio looks intelligent when markets rise and becomes a moral test when they fall. Many people discover their risk tolerance only after the drawdown arrives. By then, the discovery is expensive. A properly defensive sleeve can reduce the need for dramatic decisions in ugly periods. That is not inefficiency. That is survival intelligence. Compounding does not work if you keep interrupting it to protect yourself from pain. You never should have taken in that size to begin with. That is why 5 categories matter. You want enough variety of economic drivers that the whole structure does not depend on one kind mood from the market gods. Something should always be doing its job. That is how a person remains in the game long enough for time to matter. Now we come to the part nobody likes discussing honestly. 3, not 3 asset classes. 3 emotional enemies, 3 phases that try to break the owner before the math can begin helping him. First comes doubt. This is the early phase. The account is small. The movement is unimpressive. The owner is still doing almost all the heavy lifting himself through contributions. He sees other people chasing hotter things. He hears stories about fast gains. He sees nonsense get more social attention than patience ever does. And the mind begins whispering, maybe I am doing this wrong. Maybe I am too conservative. Maybe the whole point of investing is to be more aggressive than this. Maybe compounding is just a pretty story used to console slow people. That whisper destroys many lives, not all at once. Quietly, a person in doubt often abandons the structure for something louder. He trades the invisible path for the visible thrill. Then he calls the outcome bad luck. Second comes frustration. This phase is cruel because it often arrives after enough time has passed that the person feels he has earned visible progress. But not enough time has passed for the curve to become persuasive. He has done the right things, he has invested monthly, he has held through some boredom, he has perhaps even held through some volatility, and still the number feels smaller than the sacrifice. This is where many people begin rating the future. They pull money out for consumption. They tell themselves they have been so responsible that they deserve a little reward. They redirect funds into something that feels more exciting. They start over mentally while pretending they are merely adjusting. That is usually self-sabotage disguised as realism. Frustration is the phase where the person is closest to quitting right before the machine begins to feel less manual. That is why it is so dangerous. Third comes panic. This one always arrives with a market event, maybe a crash, maybe a sharp correction, maybe a recession, maybe some headline that suddenly makes everyone feel smarter about fear than they did about optimism 6 months earlier. The portfolio drops. The owner sees not only gains erased, but sometimes principal threatened. That is when the primitive part of the brain begins shouting, "Get out. Protect what is left. Do not be stupid. Do something." Action feels morally superior in moments like this. Often it is economically inferior, because what the panicked person calls protecting himself is frequently just transforming temporary damage into permanent loss. Every major panic teaches the same lesson. The people who sell because the pain has finally become intolerable usually donate the recovery to the people who stayed or bought more. That is how money changes hands. Not from the ignorant to the brilliant, often from the emotional to the prepared. So if you know these 3 phases are coming, what do? You build an emotional operating system before you need one. First, stop checking the account so often. This sounds almost childish in its simplicity, which is why people ignore it. If you look every day, you are handing your nervous system to fluctuations too small to matter and too frequent to interpret wisely. Checking every day does not make you more informed. It often makes you more reactive. There are periods when a person would be far wealthier if he had a way of seeing the account only occasionally. Second, automate contributions. I like automation because it bypasses mood. Mood is no way to run a financial life. When the contribution happens, whether you are excited or bored, frightened or calm, the structure outperforms the emotion. That is exactly what you want. Third, measure progress in more than one way. Do not look only at balance. Look at share count. Look at consistency. Look at savings rate. Look at how much you have contributed relative to who you used to be. A person can make tremendous progress before the account becomes large enough to flatter him. Do not miss that evidence just because the ego wanted fireworks. Fourth, study history. If you do not know what markets have done before, every future drop feels unprecedented and personal. That is bad for behavior. Once you understand that severe drawdowns, recoveries, long flat periods, euphoric surges, and painful resets are all part of the long record, you become less likely to mistake normal market violence for a signal that the whole structure has failed. That historical perspective is not academic. It is emotional armor. Now I come to the final number one annual increase. One deliberate upward adjustment in your contribution rate each year. This sounds minor, that is why it is so powerful. Little increases rarely frighten people the way giant lifestyle shifts do. A 5% increase in monthly investing often feels almost invisible in present life. Over decades, it is anything but invisible. The mistake people make is keeping contributions flat while assuming time alone will do all the work. Time is necessary. Time is not everything. Real life changes. Income changes. Debt gets paid down. Raises happen. Skills improve. Expenses shift. If every bit of increased capacity immediately becomes increased consumption, then the financial structure stays weaker than it should. If part of that increased capacity is captured and redirected into investments, the compounding engine begins receiving better fuel every year. That changes everything. Let us say a person invests $300 a month for decades and never changes it. He will likely do fine. Now let us imagine that each year he nudges the amount upward a little. Nothing dramatic, just enough that the contribution grows with his capacity. That extra act does not merely add more money. It accelerates the rate at which the portfolio becomes self-propelling. More principal, more reinvested gains. More distance from the stage where contributions feel lonely. This is one of the cleanest examples of how adults get rich without appearing dramatic. They make a small structural upgrade each year. The crowd is looking for giant opportunities. The adult is quietly improving the machine. I admire the adult. Now, take the whole framework together. 7 years of committed time. 5 distinct portfolio roles. 3 emotional traps anticipated in advance. 1 annual increase in contribution. What does that really do? It transforms the experience of investing from random discomfort into predictable construction. That is a huge difference. The person without structure feels every stage as a separate drama. The person with structure begins to understand which part of the process he is in. That reduces fear, and reduced fear usually improves results. I think this matters especially for younger investors because they are most likely to misinterpret the beginning. A 25-year-old or 30-year-old can easily look at a modest account balance after several disciplined years and conclude the process is too slow to matter. That conclusion is understandable. It is also one of the costliest wrong conclusions in finance, because the early stage is not where the magic is visible. It is where the base is assembled. And without the base, there is no later acceleration. A person who quits in year 4 or 5 is not missing one more year. He is often missing the whole category of experience, where the portfolio stops looking like a jar for spare effort and starts looking like an active partner in wealth building. That is why I tell people to respect the base, building years almost religiously. Those are the years when identity gets formed, the years when you learn to live below what you can consume, the years when you learn that consistency matters more than excitement. The years when you stop asking whether the process is entertaining and start asking whether the process is sound. That shift in character is worth almost as much as the eventual money. A person who learns how to keep going when progress is slow becomes dangerous in every field that compounds business, investing, writing, marriage, health, reputation, all of it. The impatient never stay long enough. The disciplined often look ordinary until the results finally arrive all at once to people who were not paying attention. I want to be very clear about something else. This framework is not about getting rich quickly. I distrust anything that leans too hard on speed, because speed usually requires either luck, leverage, or self-deception. This is about inevitability. That is a much better word. If the structure is sound and the person remains inside it long enough, the odds begin working for him so strongly that the whole process starts to feel less like hope and more like mathematics. That is a beautiful feeling, not because it removes uncertainty, it does not, but because it transforms the emotional texture of money. In the beginning, the person is begging the account to prove itself. Later, the person begins trusting the account because he understands the machine underneath it, and trust built on structure is far stronger than trust built on optimism. I remember a man who started in his mid-30s with modest monthly investments and a perfectly ordinary income. He was not famous, he was not a financial obsessive, he was simply willing to be a little more boring than his peers. He stayed the course in the early years. He did not chase every fashionable idea. He used broad ownership as the base. He owned quality dividend payers. He gave himself some growth energy in smaller businesses. He kept international exposure. He held enough defense that he did not lose his mind during ugly periods. He raised his monthly contribution a little every year. Nothing heroic, nothing dramatic. And because it was not dramatic, many of his friends did not respect it. They respected the louder things, the one who made a quick speculative gain, the one who bragged about turning a small trade into a big win, the one whose consumption looked expansive. The quiet builder was easy to overlook until 15 years passed. Then 20, and what looked boring in year 3 looked intelligent in year 22. That is how compounding works socially as well. It hides the effort long enough that the crowd mistakes the outcome for mystery. There is no mystery. There is only process hidden by time. Now, if you are going to use a system like this, you need a few practical rules. Commit in writing to a long horizon. I like 7 years as a minimum because it forces you out of the tourist mindset. Tourists are not owners. Tourists want the market to entertain them. Owners want the business of progress to continue. Next, give every piece of the portfolio a job. Do not buy assets because they are popular. Do not buy them because they are in the headlines. Buy them because they perform a role you understand. Base growth, cash flow, high upside smaller growth, global exposure defense. If you cannot explain the job, the asset probably does not deserve the seat. Then prepare emotionally before the emotional phase arrives. Do not assume you will be rational later if you have not thought deeply now. Write down what you will do if the market falls hard. Write down how often you will review. Write down why you are invested. Write down what kind of behavior would count as self-sabotage. A written philosophy is very useful when fear starts pretending to be wisdom. Finally, capture every improvement in income. This matters more than most people realize. When you get a raise, the easiest place for it to disappear is into lifestyle. Lifestyle is a powerful predator. It can eat every bit of growth in earnings and leave a person wondering why he still feels stuck. Do not feed it everything. Let some of each increase strengthen the machine. That is how small salary growth becomes major wealth over time. Not by accident, by capture. If you do these things, then the exact date when compounding starts to feel dramatic will vary. But the transition itself becomes much more likely. And when it does happen, it feels almost unfair in the best possible way. The years that once looked static begin producing visible momentum. The balance starts growing by more than you expected. The contributions no longer feel alone. The gains begin helping. You notice that the account is capable of movements that once would have required months of labor from you. That is the first moment many people finally understand what they were building all along. The account has started working with them rather than merely waiting for deposits from them. That is the crossover. It is not magic. It is not luck. It is accumulated patience meeting enough scale. Now, some people will hear all this and still say it sounds boring. They are right. It is boring. That is one of its great strengths. Boring is usually what survives. Boring is what does not tempt you into unnecessary drama. Boring is what can be repeated when life is messy. Boring is what keeps working while exciting. People keep resetting their plan. If you want to get rich inevitably rather than theatrically, you had better become comfortable with a little boredom. Boredom is not the enemy. Impulsiveness is, confusion is. Comparison is trying to compress a 30-year process into 3 emotionally satisfying quarters is. I would much rather be bored and compounding than entertained and stagnant. That is an easy trade. And if you feel right now that the account is moving too slowly, let me tell you something important. Do not insult the early stage merely because it is not yet spectacular. The early stage is where the entire future is being built. The early stage is where the habit is formed. The early stage is where the portfolio is being taught what it means to receive capital regularly and stay invested through discomfort. The early stage is where you prove whether you want to feel rich or become rich. Those are different desires. Many people never sort them out. So when you sit there looking at a balance that feels too small for the amount of discipline you have shown, remember this. The numbers are not mocking you. They are testing whether you understand where you are in the sequence. 7 years to let time do its first real work. 5 categories. So the structure does not depend on 1 lucky wind. 3 emotional enemies that must be expected, not feared. 1 yearly increase, so the engine gets stronger instead of merely older. That is the framework. Simple enough to remember, hard enough to follow that most people will not. Good enough to change a life if you do. And that, in the end, is the whole game. Not finding excitement, not finding genius, not finding a shortcut, finding a structure that reality respects and then respecting it long enough yourself. That is how small monthly decisions turn into large financial outcomes. That is how the slow beginning eventually becomes that is how time turns discipline into visible wealth. And that is why the people who stick through the ugly beginning are so often the ones who get to enjoy the beautiful finish.